TSMC just reported one of its strongest quarters ever. Revenue increased, profits exploded, and artificial intelligence demand remained strong. However, TSMC stock still dropped after the market opened. So why did investors sell such impressive earnings? TSMC stands for Taiwan Semiconductor Manufacturing Company. The company manufactures advanced computer chips for companies like Apple, Nvidia, and AMD. Major customers include companies connected to smartphones, computers, and artificial intelligence. TSMC doesn't design most of the chips it produces. Instead, it operates the factories that manufacture those advanced designs. TSMC reported second quarter revenue of about $40 billion. Net income reached nearly $22 billion. Quarterly profit increased approximately 77% from 1 year earlier. Earnings also exceeded what many Wall Street analysts expected. These numbers would normally appear very positive for investors. TSMC shares opened lower in the United States. The stock briefly fell below $400 during morning trading. It later recovered part of that early decline. However, the negative reaction still confused many investors. Stock prices usually reflect what investors expect next. They don't only reflect what a company's already accomplished. Before the report, many investors expected TSMC to deliver excellent results. So because of that, the strong earnings were not a surprise to the market. Investors compare actual results against expectations already built into the price. Imagine expecting someone to score 90 points on a test. A score of 92 would still be excellent. However, it would feel disappointing if everyone expected 98. Something similar happened with TSMC's earnings reaction. Some investors purchased TSMC shares before the earnings announcement. They expected strong numbers and a possible stock increase. Once the report arrived, the traders began taking profits. This behavior is commonly called selling the news. That can push a stock lower despite excellent results. TSMC was not falling by itself. Semiconductor stocks were already experiencing a difficult trading session. Several major chip and memory companies declined during morning trading. The semiconductor ETF known as SMH also dropped sharply. Broader industry weakness placed additional pressure on TSMC. Manufacturing the world's most advanced computer chips requires enormous investments. TSMC continues spending heavily on factories and new technology. The company announced another major expansion inside the United States. That spending could support tremendous long-term growth. However, it can also pressure profits and cash flow. The earnings report did not suggest artificial intelligence demand was collapsing. Advanced computing remained a major driver in TSMC's growth. The company also provided another strong revenue outlook. That supports the long-term argument for the business. However, long-term growth doesn't guarantee immediate stock gains. TSMC can remain an outstanding company while its stock declines. A stock price also depends on valuation and investor expectations. Paying too much for growth can increase short-term risk. Even strong businesses experience corrections and disappointing market reactions. Investors should separate company performance from daily price movement. Investors should watch whether AI demand continues supporting future revenue. They should also monitor profit margins and factory construction costs. Future guidance may matter more than this completed quarter. The broader direction of semiconductor stocks will also remain important. These factors could determine why today's decline becomes temporary. Excellent earnings don't automatically make a stock rise. The market constantly compares results against previous expectations. Sometimes great news has already been priced into the stock. That's why investors should avoid judging earnings from headlines alone. Always examine expectations, guidance, valuation, and the broader market. TSMC delivered record earnings and continued benefiting from artificial intelligence. The stock fell because investors expected extraordinary results already. Profit-taking and semiconductor weakness added more selling pressure. This decline doesn't automatically prove the company is failing. It shows that stock prices often move differently from business results. This video is for educational purposes only, and it's not meant to be personal investment advice. If you found this video interesting, give it a like, subscribe, and I'll see you in the next one.